All right, let's talk about BMNR. We're diving into a really fascinating data-driven squeeze thesis that suggests a massive move could be right around the corner. We're going to break down all the evidence, piece by piece, like a detective story. So let's jump right in.
Okay, so here's how we're going to tackle this. First, we'll look at the big contradiction at the heart of it all. Then, we'll follow the clues. Who are these invisible buyers? What's this short seller's trap? And what's the deal with this regulatory time bomb? After we've got the clues, we'll find the smoking gun, the technical proof, and then wrap it all up with the key levels you need to be watching.
So, let's get right to the core of this puzzle. You look at the chart for BMNR, and honestly, it looks pretty weak. But that's the thing. If you just scratch the surface, the data is telling a totally different story. And let me tell you, it's a way more explosive one.
And that brings us to the big question, right? The stock price is falling, so how on earth could a massive move be coming, like within 24 hours? It sounds crazy, but the answer? Well, it's kind of hidden in plain sight. Okay, clue number one. To find the answer, we have to go off-road, away from the regular stock exchange and into, well, the shadows of the market. The argument here is that the chart you and I see is basically a distraction. The real story, the real action is happening somewhere else entirely.
And that somewhere else has a name. Dark pools. Seriously, that's what they're called. The best way to think about them is like a VIP room for the stock market. It's where the huge institutions, the whales, can go and buy millions and millions of shares without anyone in the public market seeing it. It's all about moving in stealth, so they don't cause the price to spike before they're done buying.
Now this is where it starts to get wild. Just look at the scale of this for BMNR. According to the data, almost half, 48%, of all the trading was happening in these dark pools. Think about that. Nearly half the action was completely invisible to the public. That is a lot.
And that percentage translates into an absolutely massive number. We're talking over 27 million shares being bought and sold in the dark. This is the definition of institutional accumulation. This is them loading the boat, as they say, all while the public chart is designed to look weak. What they're doing is building up this enormous hidden wall of demand.
All right, on to our second clue. So we have all these hidden buyers, right? But what about the other side of the trade? Well, it turns out there's a huge and very visible group of people betting that this stock is going to go down.
The short interest right now is sitting at a really high 17.47%. That's another 27 million shares sold short. And here's the most important part to remember about short selling. It's not a one-way street. Every single one of those shares has to be bought back eventually to close the position. So you've got this guaranteed future demand just sitting there, waiting.
But wait a second. Here's a weird wrinkle. The fee to borrow shares to short them, the cost to borrow, is pretty low, only 28%. Now that doesn't quite add up. Usually when a stock is a huge squeeze risk, that fee goes through the roof. A low fee like this would normally make you think, oh, maybe there's no real risk here. So what's the deal?
Well, the theory from the source is pretty clever. That low fee, it's not weakness, it's bait. It's like leaving out cheap cheese for the mice. The goal is to make it super easy and cheap for more and more people to short the stock, to pile on that side of the boat. Why? Because the more shorts that get trapped, the more explosive the squeeze will be when this thing finally turns.
So let's recap. We've got huge hidden buyers on one side and a growing pile of trapped sellers on the other. It's a powder keg. But you still need a match to light it, right? You need a trigger. And that's our third clue, a regulatory time bomb. This isn't a theory anymore. This is about the hard and fast rules of the market.
And to understand this time bomb, we need to talk about something called fails to deliver, or FTDs for short. It's basically what it sounds like. Someone sells a share, but when it's time to actually hand it over, they can't. They fail to deliver. It's like an IOU gets stuck in the system. And with BMNR, the number of these IOUs just went ballistic.
And when I say ballistic, I mean it. The numbers here are just mind-boggling. The data points to a spike of almost 72 million shares that failed to deliver. 72 million. That is an insane number. It's nearly 3 times the entire volume we saw being bought up in the dark pools. Just think about that for a second.
Okay, so this is where that ticking clock starts. There's a rule called T plus 35. And it basically says you have 35 days to make good on those IOUs. It's not a request, it's not a suggestion, it's a hard deadline.
After that, the system itself can force the shares to be bought on the open market. And guess what? We are right inside that forced buy-in window now. This creates a guaranteed, non-negotiable demand for millions upon millions of shares.
Okay, so we've got the hidden buying, we've got the trapped shorts, and we have a forced buying event on the calendar. But is there any hard proof? Like, can we actually see the fingerprints of these big institutions on the chart? Well, let's go find the smoking gun that ties this whole story together.
This is where we talk about something called a bullish divergence. It sounds technical, but the idea is super simple. Normally, when a stock's price goes down, the indicators that track money flow also go down. Makes sense, right? Price down, money out. But with BMNR, something really weird happened. As the price was hitting a new low, the money flow, it went up, sharply.
Yeah, the Chaikin money flow indicator, which is a great tool for seeing what the smart money is doing, spiked to a really strong positive number. Seeing a reading this high while the price is tanking, that's the classic technical fingerprint of huge institutional buying. It's the proof right there on the chart that someone with very deep pockets was just sitting there, absorbing all the panic selling. It validates the whole theory.
All right, so we get the why. The setup is clear. Now let's talk about the what's next. How does this play out? The source material gives us a really clear battleground map with the key price levels that are going to tell us who's winning this fight, the bulls or the bears.
Okay, here's the game plan. For the bulls, everything hinges on one number, $30.26. A break above that on high volume is the trigger. That's the green light. If that happens, the next targets are $30.81, then $32.22, and from there, we start looking at a real squeeze above 34 bucks. Now, what if that fails? If the price gets slammed down at 30, the bears could try to push it lower. But the view here is that this would just be a final shakeout to scare people off before that forced buying from the FTDs has to happen. So a dip might even be seen as an opportunity. So let's just boil this whole thing down to 4 numbers. You ready? 27.1 million shares bought in secret. 71.9 million shares that are forced to be bought. 17.47% short interest just sitting there as fuel. And a plus 0.352 CMF reading, the technical proof. You put those 4 pieces together and, well, the picture becomes pretty darn clear.
And this whole thing really leaves us with a big final question from the source material. We've just walked through a situation where half the trading is done in secret and where market rules are about to force a massive buying spree. It really makes you think, when all of these hidden forces are at work, what does that price you see on the screen actually mean?